Lots of people have questions about estimated tax payments. Perhaps your tax preparer provided you with estimates, but you don't know why. Whatever the reason, you found this video and are wanting to know more. Of course, I can't explain your specific situation, but this video typically answers almost all questions that my clients have about estimated tax payments, if not all of them. If you still have questions, reach out to your tax advisor, or if you need to, reach out to me so that I can clear these up and help you better understand your situation. Now, I'll briefly cover why estimated tax payments exist, who needs to make them, when they're due, how they are calculated typically, and options to simplify or avoid them. The tax code requires us to pay in our federal income tax as we go over the course of the year, rather than waiting until the tax return due date. For W-2 employees, this happens automatically. Your employer withholds a portion of each paycheck and sends it to the IRS on your behalf. But if you receive income that isn't subject to withholding, like self-employment earnings, rental income, or investment gains, you might need to send estimated tax payments in yourself. You must make quarterly payments if, when you file your tax return, you owe more than $1,000 in tax after subtracting any withholding. If you're fully self-employed, you'll almost always need to pay quarterly. If you have a W-2 job plus other income, if your withholding doesn't cover all your tax, you'll need to make estimated payments to cover that gap. Estimated payments are due 4 times each year: April 15th, June 15th, September 15th, and January 15th of the following year. Missing these deadlines or underpaying the amount due at each quarter can trigger interest and penalties. Now, you don't actually know what you're going to owe this coming year. You don't have a crystal ball. Because you don't know your exact income for the year in advance, the tax code offers a few safe harbor methods to avoid penalties and interest. The one that your tax preparer will normally use is the 100% 110% rule. If you pay at least what you owed last year, you won't have to pay any penalties or interest. If your income goes up, you still will likely owe additional taxes at tax time, but because you hit that safe harbor, you won't owe any penalties or interest on under withholding. Now, this safe harbor increases from 100% to 110% if your adjusted gross income is over $150,000 in the prior year. So your current year estimated tax payments are probably based on your finalized prior year return that was just completed in order to hit one of these safe harbors. If you have W-2 income, you can adjust your Form W-4 so that your employer withholds more tax each pay period to cover your other income. This can eliminate your need to make estimated tax payments even if you have other income that doesn't have withholding on it. As long as the tax gets paid, the IRS doesn't really care where the payments came from. So taxes owed on a side hustle can be paid with extra withholding from your W-2 day job, and that would allow you to avoid needing to remember to make these quarterly estimated payments. So you should review the payment schedule and mark your calendar for April, June, September, and January 15th. Decide on a payment method. Now, I recommend direct pay through the IRS website at irs.gov/payments. Or if there were vouchers provided to you from your tax preparer, you can use those and mail your payments in. Feel free to contact me if you have questions about your specific situation and you need some more help. You can reach out to us. As a real quick recap, you must pay your taxes as you go throughout the year. For the majority of people, this happens through their paycheck. But if you don't have a W-2 job, or if you have other income on top of your W-2 job, you likely will need to make estimated tax payments on a quarterly basis. If you have a W-2 job, you can avoid these by increasing W-2 income tax withholding. Otherwise, you're going to need to make these quarterly payments in order to avoid interest and penalties at tax time. Now, the estimates are likely based on your prior year information if your tax preparer provided them at tax time. They are estimates, and if your income increases, you could still owe more tax at tax time, but at least you will have avoided penalties and interest by using the safe harbor method. Lastly, if you expect significant changes in the current year, those estimates should be updated based on a projection of the current year realities. Now, I hope this video was helpful. Please like this video, share it with others, and subscribe to the channel so that you're notified when new videos come out. Thanks for watching.